I'm Chris Colbert. Welcome. Have interest rate increases come to an end? Well, that seemed to be the signal from the European Central Bank on Thursday, which has kept its key lending rates steady. At the meeting in Frankfurt, ECB President Christine Lagarde said the board hadn't discussed raises at all. That's in line with similar decisions not to boost rates by the Federal Reserve in the US and the Bank of England. Leading up to these policy meetings this week, we've seen interest rates around the world on a steady climb for just about 2 years, starting at just about 0% in the US, the Eurozone, as well as the UK, and eventually reaching 4% in the Eurozone, 5.25% in the UK, and 5.5% in the US. Now, this week, it seems like a plateau has been reached. For more, let's bring in Vicky Price. She is the Chief Economic Advisor at the Center for Economics and Business Research in the UK. Welcome, Vicky. Do you agree that this is it? Inflation has been successfully fought, no more rate hikes?
I do agree. Now, of course, what we've been hearing both from the European Central Bank and also from the Bank of England, and some hints about that also from the Fed, is that they're not completely convinced that inflation has been sorted out, and they're standing ready to increase rates if necessary. Now, the question is, do you believe that? And the markets obviously have decided they don't believe that, and they think that the path is now downwards. And despite what the ECB has said today, the markets still expect interest rates to come down quite significantly by a number of cuts, which will happen during the course of the year. That's not, of course, what Christine Lagarde said, and I listened to the press conference, and what she did say is that it will be data dependent still, despite the fact they're giving some guidance that rates will stay high for a while. What she's also saying is data might change, and we're going to look at that quite carefully.
If we take a look at what the ECB has decided, if we see that inflation in the Eurozone has been coming down to 2.4%, which is just above the target of the ECB, what does that tell us about the state of the Eurozone economy?
The economy isn't doing particularly well at all. We know that in the last quarter, GDP fell a little bit, and there are some countries in recession. In particular, of course, Germany. And Germany, as again Christine Lagarde reminded us all, is 25% of the Eurozone economy. Very, very important there. And we've seen the Dutch economy also seeing a decline in GDP in the last quarter. So it is basically a situation where nothing much is happening economically, and where the trends, if anything, are downwards. We've seen also more recently the data from the PMI, which is the Purchasing Managers Index, which for October, and also what's happening more recently, the suggestion is that, in fact, it's falling still. It's in contraction territory, and it's been in contraction territory when you look at manufacturing and services and construction altogether since the summer. So that's, again, not very good news. It's slightly less in contraction territory, but it's still in contraction territory. And we're having lending condition also quite tight. So I think those interest rates do harm businesses and households across the Eurozone. And I think that's something which will need to be addressed at some point.
If that is the case, Vicky, as you pointed out, if the Eurozone economy is teetering on the brink of a winter recession, we have all this data coming in, which is quite disappointing. Why does the ECB then, why isn't Christine Lagarde not more a bit of outspoken when it comes to signaling support for the ailing economy?
I think the central banks generally have all suffered a bit of a crisis of confidence because, of course, inflation increased a lot faster than they had anticipated. So they now want to be seen as the sort of guardians, if you like, of the inflation picture. And they want to also adjust inflation expectations. They want to remain themselves quite hawkish in what they say, so that wage demands do not increase significantly, and therefore we don't have an inbuilt sort of wage push inflation becoming actually the norm, the sort of thing that we're seeing in the UK right now, which is quite worrying. So I think it is just expectations management, if you like, but I don't think it can be sustained for any length of time. And you're absolutely right. With such low inflation rates, more or less on target already, and with deflation in some of the countries in Europe, you do wonder how they can possibly keep rates where they are for any length of time.
I want to ask you one more question about the Eurozone. How much is Germany holding back growth in the Eurozone right now?
There is an issue that Germany, of course, has been very badly affected by what's been happening in Ukraine and the gas supply situation, and had to restructure its economy quite significantly, cut back energy demand quite substantially, and some of its big energy-intensive sectors have suffered. And also, of course, its exports have been affected by the fact has been, of course, having its own problems. So Germany is definitely sort of dragging the rest of the economy down of the Eurozone. So it is very, very significant. Now, are such high interest rates at all, appropriate for a country like Germany? It's a question mark. But on the fiscal side as well, Germany is now having some difficulties in terms of being able to spend enough as it would have liked to in a number of areas, including green investment, and infrastructure spending has suffered. So yes, I think Germany is in difficulty, and I think anything that may happen on the interest rate front rather faster than is anticipated by the ECB, I think would be very helpful for the Germans.
In the UK, in Britain, interest rates are even higher than in the Eurozone. Key lending rate there at 5.25%. Now, the Bank of England kept that rate untouched. Is that the right decision in light that the UK economy is also not performing particularly well?
You're quite right. It's not performed particularly well. We saw a drop in GDP in the previous month, the last month where we have data for, which is October, of 0.3%. It does suggest that we may have either zero growth again this quarter, or perhaps even a negative quarter. In other words, technical recession. It is an issue. Very surprising to me that whereas the ECB decision was unanimous to keep rates on hold, in the UK, 3 of the 9 policy makers at the Monetary Policy Committee of the Bank of England voted to raise rates, which makes absolutely no sense. Given the economic environment. Yes, of course, our inflation is considerably higher in the UK than either in the Eurozone or in the US, but nevertheless, the economy is unlikely to be doing particularly well over the next few months either. And we have some pretty negative data coming through as well in terms of business confidence and investment. And that's not the basis really for encouraging growth at all. So I don't know why that was the case. But again, the markets don't believe it, and they think that interest rates are going to be coming down at various stages over the course of the next year.
In fact, UK inflation has been falling and stood at 4.6% in October. How much further does inflation have to come down, do you think, for the BOE to start cutting rates in order to prop up the economy?
I think there will be the odd month when it goes up a little bit, because we have now put through the system an increase in the prices that households pay for the energy. It's going to be coming through in January. So it's going to be a bit of an interesting month. And service inflation is still quite high. Loads of things are now being charged to consumers additionally, such as whether it's mobile costs or motor insurance. And also, of course, we're seeing the proximity to Christmas means that lots of prices are going up. So I think it's going to be an interesting time for a while. But I think they want to see that the wage push element of this inflation period that we're seeing is coming to an end before they feel that they can seriously start cutting interest rates, which is a problem, because unfortunately inflation expectations in the UK have been so high for so long that getting that to move downwards might take some time. And unfortunately, we've had these increases in interest rates for some time now. What it means, if you look at the gap that it takes, the time it takes for them to have an impact in the economy, we're getting there now, which means that perhaps actually the economy is going to be doing even worse in the coming months than had been anticipated originally. So I hope that the two may balance themselves out somehow, and we might see those rates again come down here pretty soon, despite what the bank is saying.
As you mentioned, the wage discussion there in the UK, how does employment factor into the equation? The number of job vacancies in Britain has been declining.
It's true, but there's still just under 1 million vacancies there. And the debate that's going on right now is the economy incapable of having more growth because there are supply constraints? Well, there are some people who think that's the case. So that's why they want interest rates to be higher. They think there is an inflationary bias in the structure of the UK economy. But if you do have so many vacancies and investment has been constrained by high interest rates, there is still possibility of expanding that output in the economy by reducing rates and by ensuring that you start employing those people properly. And of course, if you do, some of those wage pressures will also go. So there's a big push now to see how can we get those people who are out of work or who have are, if you like, not doing anything at all, even though they could possibly come back and contribute to the economy, become more active again. So that's a big debate. How do we get productivity perhaps to increase? How do you get growth to develop again? But I think the supply constraints that are being imagined right now are perhaps exaggerated. I don't think we have them. There is huge capacity still out there, and it could in fact regenerate growth if it was done the right way.
Vicky, let's take a look across the pond. U.S. GDP growth stood at 5.2% in the third quarter. Why is growth in the U.S. so much stronger than on the other side of the Atlantic?
Well, the first thing to say is, of course, that's an annualized rate. So it's what happened in the quarter, multiplied more or less 4 times. So it's a lot less than that. Nevertheless, growth in the US economy is likely to be 2.5% in 2023. Remember, of course, that the US was one of the least hit countries from the energy crisis because, of course, they're self-sustained, if you like, or self-sufficient in energy. They haven't had the price increases that the rest of us have had. They haven't had the supply constraints that the rest of us have had. And therefore, they've been able to have generally lower inflation and also, of course, better growth. Which is interesting because what is going on there is that indeed you have now a lot less inflation, lower than the UK, almost the same as in Europe, well, a little bit higher, but with much higher growth, which suggests to me that the economy has this potential to absorb, if you like, some of those shocks. And you also have the fiscal side, which is quite positive. I mean, the Bidenomics with all the extra money and subsidies that are being given there is also sustaining the economy. And yet, the Federal Reserve is quite prepared to say we're going to start cutting rates during 2024, 3, and more coming in 2025, and possibly more in 2026. So they seem to be a lot more confident in their ability to keep inflation low, despite the fact that growth is considerably more substantial there than it is over here. But they have said that they think that growth is likely to be moderating, and they think therefore that lower interest rates is compatible with that.
With inflation expected to be less of an issue in the coming months, what are the headwinds for the UK economy and for the Eurozone economy, in your point of view, in the coming year?
The good point is indeed that inflation overall should be coming down, mainly because it was engineered, if you like, by what happened in Ukraine, the energy crisis, and food prices, which were very high. Now food prices have been coming down for a very long period. If you just look back, we're back to pre-pandemic levels, basically. And energy prices, which were feared might increase because of the OPEC production cuts, are now either not just stabilizing, but falling. So we've seen prices having come down quite significantly. So all that's pretty good. I mean, the real worries that you still have is trade overall, globally, not doing particularly well. China still being in difficulty, and we've seen some of the output data, which isn't particularly good. But China right now is exporting deflation, so prices are falling. So my main concern is that we may not adjust quickly enough to that inflation profile, which is improving, and that we might, in fact, leave interest rates up there for longer than is necessary. And I think that's the concern. Again, just thinking back to the ECB press conference, that was precisely what was being asked by a number of the journalists who were around there at the time.
Nevertheless, markets are betting on lower rates. And for years of 0% interest rates and tons of cheap money, we've been hearing that it's dangerous for financial markets to get too used to this kind of cheap cash. Is it alarming now that investors are pushing markets to new highs in anticipation of central banks to make borrowing cheaper again? Perhaps
up to a point, we should be quite pleased about the fact that confidence is returning in the markets. And indeed, we're seeing some record high prices coming back to the market, if you like, in the sense of that type of confidence pushing stock prices up, share prices up, which is, interesting. But what we need to worry about is that before the ECB decision, European stocks were also doing very well. And I think the market, as I said, still doesn't believe that rates will stay very high. But we have to watch it that if interest rates do not start coming down as fast as the market thinks, then there could indeed be some fallback. And indeed, some fingers will get burned.
Vicky Price of the Centre for Economics and Business Research in the UK. Thank you very much for your analysis.
Thank you.
And that's all from this DW Business look at interest rate decisions and their implications for GDP growth. There's plenty more from us here on the DW News YouTube channel. I'm Chris Coburn in Berlin. Thanks for watching and see you soon.